Good morning, good afternoon, and good evening, depending where you are on the planet. And welcome to the Wednesday, the 3rd of May, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. Going to go through usual regular run through in here, calendar, what we've had, what we've got coming up on the macro calendar, quick look at the earnings calendar. Parking the earnings calendar soon. I'm going to cover it today, tomorrow. Actually, no webinar. Point of information, no webinar tomorrow, no webinar on Thursday. Let's get that out of the way at the beginning. No webinar Thursday the 4th of May. So unless, well, I'm going to say no webinar. Check out, unless James can cover. I do appreciate, it's a big evening tonight, but unless James can cover, well, evening for us, afternoon if you're in the US, with respect to the Fed. But if James can cover, he will. But if not, no webinar tomorrow. I'm unable to cover the webinar tomorrow. But we'll take a look at the calendar, the both the macro and also the earnings calendar. Take a look at some articles from the major news wires. Take a look at, very briefly, look at the charts in here, because we're going to explode post Fed, and expecting it very quiet pre Fed, and then no doubt going to see some kind of significant price action post Fed. So it will be a very, very, very quick look at the charts. So let's take a look at what we got had and coming up in here. Going back actually to yesterday, we did get the where are we? We got the coming up today. And so, yesterday was fairly quiet, right? Jolts data didn't really do anything. Markets drifted lower, and primarily because of ongoing concerns with regard to the regional banks. Okay, so a couple of regional banks got slammed, went limit down, suspended trading a couple of times yesterday, and that pulled the sector down and put jitters into the broader market. Not down massively, but down 1%. Obviously, maybe some position squaring as well ahead of the Fed. Going back to today in here, though, if I refresh this, hopefully it will let me go back to today. Yeah, I'm going back to today. We do have some data pre-Fed, obviously. 42 minutes in here, ADP, the precursor to the employment report. So we've got that coming up shortly, in just over 40 minutes. And then we get the S&P Global PMI is at 9:45 Eastern, probably sort of ignoring that, given one, we got the Fed, but also the superseded by the ISM data. Remember, for the US, the ISM data is looked at far more than the S&P Global data. So ISM data coming out at 10 o'clock Eastern, and we have a 9:45 ahead of there, the S&P Global. And in just over 40 minutes time, we get the ADP non-farm employment change. But clearly all eyes on the Fed at 2 o'clock Eastern, and then the FOMC press conference. 25 basis point rate hike, pretty much nailed on. Clearly looking for the Fed to at least pivot towards a now going on hold position, kind of done for now, and going on pause. And then potentially looking for some kind of hint, some kind of dovish tone that the market is now very much pricing in for rate cuts later this year. I don't think, Powell's going to indicate in any way, shape or form, or in the statement, they are going to be looking to cut rates later this year. However, they might indicate that concerns about the banking sector, then they might give some kind of positive note to inflation coming under control, slowing of the economy. If they start to hint at anything like that, a very slight hint that things are getting a little bit more under control on the inflation side and the economy is slowing, that would open the door, obviously, to rate cuts. Okay, so the market would take that as a slight dovish pivot. So I think the market is looking for that and wants that, and I'll come to the Fed tool later and see what we're still pricing in. Over the last 24 hours, we're pricing in even more chance of deeper cuts because of the concerns about what's happened, even since the JP Morgan rescue of First Republic in here. We've also seen concerns regarding other banks in here. So let's jump to that. Actually, a quick nod to the earnings report in here. Oops, wrong one in here. Sorry. Have I got the... Oh, no, I've got that twice. Let me quickly bring up the earnings report. But safe to say, in here, with regard to the earnings in here, where's the earnings calendar? So with regard to the earnings calendar in here, there's nothing really significant today. Just in case I'm not on tomorrow, the big one, and I won't really be looking at earnings going forward, but we've got Apple after the bell on Thursday. So if I'm not on tomorrow, do remember after the bell tomorrow, Apple. It's the last of the really mega cap techs in here. We have reporting the last of the FANG stocks. So watching out for Apple after the bell tomorrow. Today, I don't think any of this is going to impact the markets, given we've got the Fed up and coming. 5 things to start your day. So obviously in here, all focus on the Fed decision day, looking for a Fed pivot. Not only do we have the concerns around, did I say First National, First Republic? I can't remember what I said before. First Republic, sorry. Concern, the ongoing concerns with the regional banks after First Republic's rescue in here. PacWest, Western Alliance got smashed yesterday, lower as well in here on the overnights, and that's causing concerns in here, and potentially going to see a shift in here. So look, former Federal Reserve Bank of Dallas President Kaplan has added to the unease, saying the US regional bank crisis is far from over, and calling for the Fed to pause rate hikes. So we're getting this kind of added kind of a narrative in here of there's more potentially to come. The instability from the banking crisis from March is still affecting us, even though we didn't have any big escalation in April. Going into May, we've had a slight escalation, and that is causing concerns. It's going to put a brake on the economy, and that should then put a brake on the Fed. Okay, so, and that alongside the debt ceiling, concerns around the debt ceiling as well, that started to raise its head. Maybe Jerome Powell will mention that as well. We could see something on the debt ceiling. So the fact we've got the debt ceiling, the fact that we've got the data showing a slowdown, the inflation is slowly slowing down in here. We're getting a slowdown in the jobs market. All of that could add to the Fed actually shifting a bit more dovish in here. And counterintuitively, in some respects, or perversely, whatever you want to say, right? The fact is, we now have these negatives for the market, or negatives for the economy, right? The banking issues, okay, the debt ceiling, okay, the slowing down in the economy. It's actually now increasing the chances of the Fed being more dovish, and the market is anticipating the Fed being more dovish, and that's actually keeping stocks up, kind of counterintuitively, because the markets the equity markets are liking. So we've had actually a rebound this morning despite the negatives. So we sold off yesterday, but rebounding this morning, even though, and I'm going to jump to the Fed tool now because I think it's appropriate. So we're like, this has actually fallen, right? Less chance of this was in the mid 90s, right? So now actually got a slight chance that they don't do anything today, right? I don't think it's going to happen, right? They're going to hike today, almost certainly. But this has actually fallen because of what's happened in the last 24 hours with the regional banks. So the market now anticipating that. But also in here, if we looked at this yesterday, this was the highest yesterday. We were looking for one up 25 and then two down to be 25 below where we are now, back at 450 to 475. Currently we're 475, 500, expecting in May to be at 500, 525 at the end of today. However, by year end, this was the peak in here previously. Now this is the peak, 425 to 450. We're now looking for up 25, down 75 now is the likelihood by year end. Remember, it was only, I think, after the last meeting, Powell turned around and said, we're not even thinking about rate cuts, right? So potentially the market now is shifting. So counterintuitively, perversely, markets are getting buoyed, being pushed back higher today because of the negatives from the regional banking crisis, because it's going to make the debt Fed more dovish, as echoed in here by the Fed tool. So if we look in here through June and July, June standing pat, July standing pat, but even by July, starting to price in potential for a rate cut as early as July now, right? September, rate cut by Sep, okay? Then November, another one, and then by December, chances of another one. Okay, so now we're looking at maybe as early as July, certainly September, November, December, looking at rate cuts coming through in here. So the market's certainly pivoting even more dovish, and that's potentially going to pull the Fed with them. Okay, so let's just run through a few more bits more in here. So regional banks in here, a lot of fund managers now pointing to a more buying of bonds, allocating towards bonds out of stocks in here because of concerns about recession. Okay, U.S. regional bank slumps as rout deepens on First Republic flop. We've already mentioned PacWest and Western Alliance getting hit yesterday overnight as well. Banking mess and Fed among worries threatening calm stretch in U.S. stocks, but they're actually buoyed up, bouncing today. This guy is the CEO of UniCredit, a large Italian lender in here. They've just reported results, and he's basically come on the wires and saying, more to come, and you know what? Europe is, I don't see any distressed bank being rescued in Europe, but talking about more to come in the US. Okay. And so that's going to obviously, continuing to weigh on markets. And the main place it's been felt in the last 24, 36 hours has been oil. Oil's been smashed, right? Smashed lower in here. The last 24, 36 hours. So there's the oil chart over there on the right. Look, boom, smash lower in here. It's gone from basically $76, best part of, to below 70, $6 fall, nearly 10%, 8-9% in here. Oil's fallen in like 36, 48 hours. Okay, 36 hours. A massive slide in oil, the oil price in here, and on the back of concerns about recessionary pressures coming through in here. So oil lower in here. A couple of articles on that. Oil plunge deepens concerns over the U.S. economy, global economy slowing down in here because of all of this. And what we've seen on is gold pushing higher. So gold leaping higher yesterday and nudging and staying higher. So going back in here. So we've had a leap higher in gold. Where are we? Gold. Breaking out of this range, or top end of this range now that we've been in for like 1.5, 2 weeks, pointing back higher, big leap higher and holding on to those gains this morning. So gold up and oil down on these recessionary fears coming from the US, but sort of counterintuitively, but not really. This is all shifting the Fed to potentially be more dovish, and then it's helping stocks. So futures are actually up in here this morning ahead of the Fed meeting. So I don't think it's going to show, this doesn't update. I don't know. This is terrible. I don't know why they can't sort this out at Reuters. But anyway, we're down about 1% across the major indices yesterday. But in here, futures in here, notably up, not showing it on there. But if we go and take a look at the futures, I'm not going to go into loads of depth in here, by the way, guys, on the charts, because they're all going to get almost certainly blown out the water. But we saw a notable sell-off yesterday, but look how much we've bounced already, kind of stuff. So here's the S&P. Down and back up again, all the way back up again in today. You nearly got half of yesterday's sell-off back. You got some of it back overnight and then this morning as well. And that's on the S&P, and the same on the NASDAQ in here. Significant sell-off. You pretty much got half of it back where we are already, right? So decent rebounds in here this morning because of, again, counterintuitively, because of the negativity from the regional banks and because of concerns about the debt ceiling, is actually taking us higher in here, because we've seen then the interest rate markets have pivoted towards a more dovish expectation. And we can see that as well here. Look at where I look at the bond yields, boom, back down to recent lows in here from the end of May in here. But these are bond yields. And again, skipping back to the charts in here, if I go and take a look at the 10-year note, boom, back up to recent peaks in here. Not back all the way to these peaks, but, rejecting, this was setting up far more negative only 2 days ago, potential like topping pattern in here. And now we've rejected that in the last 36 hours and pointing back up to the recent highs in price, high prices, low yields, pointing back down to these low yields on the 10-year, looking back towards like 330, 325 yield, aiming that way now because of all of this. So, counterintuitively, this is kind of helping out stocks. So let's take a look, what we're going into today. Fed likely to hike rates. We know that. Hint of pause in tightening cycle. I think you're going to get more than a hint. I think they're definitely going to signal the end of the tightening cycle. Quadruple whammy whips June rate Fed rate hike off the table. I don't think it was ever on the table. I don't know where this article is coming from. There was never a rate hike on the table for June. Okay, so but it's a combination. What's the quadruple whammy? Well, it's banking sector, it's the debt ceiling, it's the jobs market cooling, and it's lending. It's issues with the credit market. All pointing through to a slowdown and potentially this more dovish pivot. And Goldman in here, look, economic and market cross currents will lead the Fed to signal a policy pivot this week. So Goldman's certainly looking in here, at least for us to shift to more of a to go on hold, on pause. But I do think there's going to be, they won't say, they're 99% sure. I'm really confident they're not going to say there's the potential for rate cuts this year. They will not open that door. But what they might do in here is pivot towards indicating all of these things, concerns about the regional banks, concerns about or that the inflation data is starting to move in the right direction, and pointing to the fact that, yes, there's more chance of recession, pointing to the fact that the labour market is starting to show not as much tightness in the labour market. All of that would be enough, I think, to affirm that they are potentially going to cut later this year. And I think stocks will like all of that in here. What else have I got for you in here? So yeah, looking into and European stocks, have rebounded this morning, decently up in here, up not much on the FTSE, the UK, but between the DAX and the CAC, the German, the French indices were up about 2/3% in here this morning. So yeah, all looking positive for me in here. I think the risk is to the upside. I think up until today, I was really thinking that the Fed would deliver the pulls, but then have no indication of any kind of dovish pivot. I think we will get a very marginal dovish pivot, and I think the market will love it. I think the market will like it, and I think all the risk is on the upside. If you don't get anything delivered, watch out, because this could plunge lower. We could really plunge lower. I think the market needs something. It needs some kind of indication of some kind of a pivot towards more dovish. If we don't get that, I think we could be back down on the lows down here on the Nasdaq and the S&P on the recent lows from last week. But for me, I think the risk is more skewed towards the highs. So I'll be coming at this from the bullish side. But do watch out. Please remember, guys, we got now a zero tolerance on putting orders in 1 minute before and 1 minute after the Fed. Okay, 1 minute before and 1 minute after the Fed. You cannot trade it. It's one of the tier 1 pieces of data, right? Remember that for the employment report. I remind you then as well. We're having zero tolerance. We see you doing that, we're going to fail you. Okay, you'll be failed on your evaluation challenge. We're not interested in people, punting over, bracket orders either side of the market going into the Fed. It's not what we're looking for. Okay, so we've made that clear. We've sent emails out there. It's in the rules. Don't do it. Okay. And before we were giving you maybe one strike, and you get another chance. No chances this time, guys. Right? We're stopping it because too many people are flouting it. Okay. Too many people are ignoring it, and we're not willing to take the risk in the live market. So if you're going to play around on the demo accounts and do it, I don't want to lecture you guys who are not doing this, but for those who are doing it, just stop doing it. Otherwise, you will just get failed on your evaluation challenge. And we can't make it any clearer. We've sent emails. We've put stuff in the forums. We've put it all over. So please don't do that. 1 minute before, 1 minute after the Fed tonight. Okay, so it's only on the decision. It's not on the statement. It's not on the press conference. It's on the conference. It's just on the statement. 1 minute before, 1 minute after. Please take all your orders out. Okay, guys, I'm going to wrap it up there. Any questions? Good luck tonight. Helmets and goggles on. Doesn't mean it's nothing about luck. Trade the price action. Be fluid. Be ready to adapt. No questions. Remember to watch out in the forums. I'm thinking probably no webinar tomorrow, but if we can get one going, we'll put it in the forums. Watch out in the forum. Watch out on the heads up. It'll be in there, okay, before the end of the day. Have a great trading day, guys. Take care. Bye.